Depending on how long you've been doing research on whole life insurance as an asset class, you've probably heard of two different narratives. On one hand, it gives you uninterrupted compound growth for your entire life, while on the other hand, it's a terrible place to put your money. So, which is it? Now, today we're going to focus in on the former, but let's first settle this myth of life insurance being a terrible place to put your money or it's a terrible investment. So, first and foremost, why do people say that? Well, it's because they're putting life insurance in the same category as investments, which is a problem in and of itself because life insurance is not an investment. And clearly, it's not an apples to apples comparison. And I would even go as far as to say as it's not even comparing apples and oranges. You're comparing apples and pasta. Like that's how different these two assets are. In other words, they should not be compared to one another. They're fundamentally designed to operate differently. Whole life insurance, when structured and used properly, is a safe place to store your money for long-term tax-free growth and access with a death benefit. In other words, it's a savings account with a death benefit. But I do empathize with those people whose knee-jerk reaction is to compare life insurance and the stock market because we live in a very rate of return centric world where my rate of return is bigger than your rate of return, and so that's the reason you should go with me. That's pretty much all we know. But frankly, friends, you can't spend a rate of return. I firmly believe that results matter way more than rate of return. In other words, what is the result of the product that I'm buying, and will it give me the result that I'm looking for long term? Now that we got that out of the way, let's talk about uninterrupted compound growth. Now, one of the unique features of high cash value life insurance is that it allows for continuous compounding growth of your cash value for your entire life. Now, unlike investments, now this is not going to be a comparison to investments, rather a contrast. But anyways, unlike investments, which have market volatility, whole life insurance policies provide guaranteed growth and then dividends on top of that to make it even better. This means that your cash value grows steadily over time without being affected by market downturn. So just kind of think about it. While the stock market kind of takes you on this roller coaster ride, your cash value in the whole life insurance policy is more like a serene, steady climb up a mountain. And the best part is that your growth is technically tax deferred from an IRS standpoint, but it's tax-free access to the cash value. And the way that you're able to do that is in one of two ways. The first way is through policy loans. The second way is through withdrawals. Policy loans are tax-free regardless, while withdrawals are tax-free up to your cost basis or the total amount of contributions that you've made into the policy. So for example, if you put $400,000 over the course of 20 years or so into a policy, let's say perhaps it grew to $500,000. If you were to withdraw that entire $500,000, $100,000 of that would be taxed at ordinary income tax rates because life insurance policies, when you take withdrawals, are taxed on a FIFO basis or first in, first out. So let me know in the comments if it matters whether or not I make a video about policy loans and withdrawals and when best to take this over that, because frankly, I am here for you and I'm happy to dialogue in the comments if you like. All right, so think of it this way. Let's say you own your house and your house is worth $500,000. You then go and get a HELOC or a home equity line of credit for $100,000. Right, you've effectively borrowed against, that's the key word there is against, you borrowed against the value of your home. So question, does borrowing against the value of your home affect the value of your home? Now, as far as I understand, the answer is no. And the value of your home is going to keep doing what it was going to do regardless of whether or not you took a home equity line of credit. This is because the cash that you receive from the HELOC comes from the bank. And that's the same idea with cash value in whole life insurance policies. When you borrow against it, your cash value keeps growing as if it were never touched, right? Because the cash that you receive when you take a policy loan and when you borrow against your policy comes from the general account of the life insurance carrier. We're just exchanging a few terms. Instead of HELOC, it's a policy loan. Instead of money coming from the bank, it's coming from the insurance company. And in both cases, the value of the core asset remains unchanged. It remains unaffected. And that's pretty much it. That's the essence of lifetime uninterrupted compounding in life insurance. And I really do hope this was helpful. I hope it was able to demystify any confusion you may have had. But if you're still foggy about this, Or if you have other items about life insurance that you're really kind of confused about, or you're still foggy about it, let me know. Meet me in the comments, and be sure to subscribe, because I don't really have a set upload schedule for these videos, and I wouldn't want you to miss out on any of the future uploads that I have coming near in the future. So that's all I got, folks. Thanks for watching. See you next time.